Hello and welcome to Moneylife. This is Sucheta Dalal. This week, we're going to talk about retail algos again. Remember, we've been taking this issue up from time to time. The question that I'm asking today is, when SEBI has finally drafted regulations for retail algos and released a consultative paper on 9th December, there seems to be so much of a noise in the media, which is all negative, as though regulation of retail algos is going to push us behind. Are these fears justified? Who really is against regulation of retail algos? Now, remember when I did a video blog in July, I had talked about how whistleblowers among retail algo writers had been writing to SEBI and asking them, please clarify what our position is, what is the regulatory framework, and the answer that they had got, and even I had got from someone informally, was that SEBI had decided that this space doesn't require regulation. But as I keep saying in these blogs, we've had such a huge burst or inflow of retail investors in the market since the lockdown in March 2020. Our investor population has almost doubled. And we have new players coming in who are trading retail algos. They do work. They want to earn more money. They have more time on their hands because most of them are working from home. And they think the stock market is a good place to be and to earn money. And retail algos give them a nice way, automated, in order to trade and make money. So this space, to my mind, needs regulation, right? So first of all, let's start with some basics. What is an algorithm? An algorithm is a code with a certain price pattern coded into it so that it triggers automated execution of trades when linked through an API. An API is application programming interface, which acts as a bridge between a broking firm as well as this algo, which people subscribe to. An algo is essentially, to put it in shorthand, a trading strategy hard-coded through a computer program, which picks out price patterns and allows you to hopefully make money. The argument is it makes money, it's back-tested, and there are literally hundreds and hundreds of trading strategies or algos that are available off the shelf or as a subscription. So far, they've been completely unregulated. Every large broker has been offering dozens of them. They even have their own in-house algos. And obviously, the market is rife for misuse, false promises, and the fact that not all algo writers are scrupulous or out there to help you. They can be used for price manipulation. The algos, we don't know what they can code in. They can be used to ramp up prices. And it's really time that the regulator wakes up and looks at it. So in July, regulator wasn't looking at it. Over time, I think pressure from all of us, SEBI set up an internal committee, spoke to people across the industry, and has come up with a new set of rules. Now, I spoke to a cross-section of market participants, about 27 of them, for feedback on what they think about the consultation paper. Obviously, not everybody agrees that there should be regulation. There are lots of different views on how retail algos should be regulated. And it's all there in a Zoom call, which is also available on this website. We can show you the link here. You can look for it. Now, all of them admit that there is mischief going on. So for instance, Saurabh Lohia of Algo G Enterprises, he has a flagship product that's integrated with 60 brokers through API. He has sort of enumerated several ways and several reasons why regulation is necessary. For instance, he says, many algo platforms falsely promise consistent and astronomical returns, which is not always possible. Some have backtesting strategies. So every time it's hard sold saying, look, it's backtested and it works perfectly. He uses the technical jargon that backtesting is curve fitted to mislead investors about what are the true returns. Disclosures are poor. There's no clarity on what happens to customer data because customers want to make money. They're very happy to share data. It is shared between brokers, algo writers, and there is this constant suspicion that at the end of the day, positions of every trader, broker, large and small, is being sold and is available to people. It can also be used for proprietary trading and front running of a certain strategy. So there are no rules even on what happens to the data. This has led to fears that rogue algos, especially since there are people who are apparently learning the programming language Python and are doing their own codes, doing their own testing, a rogue algo by someone backed with money and leverage can cause widespread losses. When that happens, when there is a problem, typical of India, it leads to a regulatory backlash. So the regulators, whether it is in banking or it is SEBI, who have been benignly watching things without moving a muscle, suddenly turn into ferocious watchdogs and start closing down businesses. Consequently, some algo writers like Dharmik Thakkar, who's been a particular whistleblower in this, he runs a company called Algo Maker. They have been bombarding SEBI with letters to say, give us clarity. SEBI then invited him and a few others for discussions. And it is these discussions and this understanding with that subcommittee that has led to the discussion paper that was put up on 9th of December. Everybody has been asked to give feedback by 15th of Jan. You are a trader and this affects you. Please read those regulations on SEBI's website and give your feedback by 15th of Jan. Like I said, for some strange reason, the media, which ought to be supportive of any move to regulate a new, big, unregulated area, which is ensnaring a lot of retail investors, has been negative. It has quoted people to say how this is a regressive move. Now, to my mind, SEBI's job is very clear in SEBI's statute and in the preamble to the statute. What is the regulator's first job? It is to protect investors and ensure a fair and orderly market. It has no mandate to facilitate higher turnover or higher profits for exchanges or brokerage. It does not have the job to even bring in many more investors into the market so that turnover increases. It has a duty to act when novice traders, I call them traders, you can call them investors, are made to believe that just an algo subscription with a very fantastic strategy, everybody claims that they have the perfect strategy, is going to put them on par with investment experts who spend decades analyzing markets and honing their trading skills. Today, people who come to the market new have come just in the last 1.5 years, 1.42 crore until March, so not small numbers. All of them believe that you just need to pick the right algo, big promises, and you are an expert and ready to go, completely automated with an API and linked up. So my belief is, contrary to media headlines, it is not negative at all. In fact, most people are all for regulation. 70 to 80% favor it. This is actually surprising because most of the time intermediaries resist regulation. Who wants capital adequacy, rules, forms, and compliances? So it's human nature to be against it. There's usually also an increase in costs. Sometimes compliances lead to delays. But in this case, by and large, there is support. There may be some quibbling about how the regulation should be framed, whether they should be in stages, what happens initially. Do you start with what happens with algos, how much of time it's going to take to clear each one of them? I think these things can be handled by SEBI when the actual framework is written, but there is no doubt that regulation was required. What has SEBI done? Let's look at the contentious issues and what SEBI has said. Essentially, SEBI's draft regulatory framework correctly puts brokers as the focal point. All of us as investors sign a fat document with a broker. We have demat accounts, we have power of attorney. So the broker is the right place for the regulation to be focused. And I think it's a correct thing to do. Public debate is also focused on whether SEBI's stand. Now, SEBI has first of all taken a stand that all orders which emanate through APIs, which is this programming interface, will be considered algo trades. There are some in the industry who are very emphatic that anybody who pays to get an API is doing it only because he wants to do algo trading. There are others, including Zerodha, who say not necessarily true. They may be taking APIs to write code, to experiment. Not everyone agrees, but be that as it may. At present, brokers insist that This is what SEBI says, okay? That although they're able to identify orders emanating from APIs, they are unable to differentiate between an algo and non-algo order emanating from an API. Now, SEBI has said you will have a unique code for the algos. Brokers will be responsible. Everything through an API will be considered an algo trade. It also puts a lot more burden by saying that the broker has to ensure that these retail algos that they offer to their clients will have to be cleared by the exchange. Each of these will have a unique algo code to identify that these are part of algo trading and not the manual trading that people do. They have to be certified by a systems auditor. Now, many of these things are already being done. This is part of the requirement that SEBI already has. And they are just clarifying and insisting that once you get it audited by a systems auditor, cleared by the exchange, the algos cannot be tweaked or altered after approval, right? And the broker also has to be in charge of redressing any investor disputes that may occur. So, like I said again, correctly, the broker is at the center of it. All the algos also have to run on the servers of the broking firm. This is also so that there are trails, and if there is an inspection or investigation, things, order confirmations, margin compliances can all be checked back with the broker and the broker servers. Brokers also have been made responsible to ensure the suitability of the product for that particular investor. They know their clients. They should know what kind of algos are suited to them and their net worth. That is also correct. The last thing that they've said is, because there's so much of rampant mis-selling and false promises, exchanges have clear advertising norms, what can be said. So brokers have been put in charge of that as well. Obviously, this, though logical, puts a burden on the broker because they have to monitor all this, but for heaven's sake, we sign a comprehensive agreement with them. May sound irksome. Now, in July this year, the largest Indian broking firm, Zerodha's founder, Nitin Kamath, had told me that, for instance, his firm offers APIs for a fee, but doesn't allow direct integration from its platform. Person paying for the API, however, can write his own algo, buy an algo, and integrate it with his system. So Mr. Kamath is actually emphatic that SEBI rules linking it to API are aggressive, but he says that his firm is going to be hardly affected because a very, very small percentage, 0.05% of his investors use APIs. He, of course, has another platform called Streak, which has over 30,000 active users, which is an internet, which is cleared for internet-based trading. This is a clearance that exchanges offer under SEBI rules since 31st Jan 2020, which is a blanket clearance, a platform clearance, without needing each strategy to be individually approved. So Streaks allows people to experiment, to do backtesting, and obviously it's a very active thing, which is separate. People use it possibly to hone in their skills or to decide what algo suits them. Now, this IBT part is interesting. I'll come to it later, but keep it in mind. Now, so while Zerodha has a very, very strong point of view against APIs, you have to remember that most other large broking firms offer a plethora of algos on their platform. They act like a platform. They allow investors to choose, like I said, from other algo writers whose trading strategies have been integrated onto their platform. These could be 40, 50 of them. They also have in-house algo writers and give their own strategies. Now, there are certain large companies like TradeTron who have innumerable algos which are integrated again with a large number of brokers. In fact, any good algo writer is integrated with 40, 50, 60, or even hundreds of brokers. And everything operates through a broker. There are commissions and they earn money for being promoted, introducing clients as well. In fact, they are appointed as remisers. I have done a previous video blog where I said it's a dubious practice because many people think that they are sub-brokers of the broker. There's only one sub-broker allowed. When the new rules allow all of this to happen directly, because SEBI rules say that you can come if you are using an API, it is considered an algo trade. A broker can offer third-party algos, broker can offer his own algos as long as the broking platform takes responsibility. Having cleared all this, the finer details of SEBI rules are still to be told to us, but surely these legitimate fees and things ought to be taken care of, and it's a small print. Now, brokers who offer a marketplace of algos are, according to me, already taking responsibility for getting exchange approvals. They're currently doing it under the broad umbrella of IBT clearances, which is internet-based trading. The moot question that everyone is worried about is whether this will continue under the new rules or will the processes be tweaked. For instance, Saurabh Lohia, who I quoted earlier, says, currently the approval process for algos and trading software is quick and inexpensive, as long as you go under IBT. His firm, as I said, has 40 odd brokers whom they're linked with. He says it takes just one working day. And stock exchanges are also pragmatic enough to recognize that if the same algo, which is cleared for one broker, comes through another broker, it is cleared faster. So he says it's not a problem provided this continues. Some others think that every single algo will have to be looked at by the exchange. The strategies will be known to exchange officials, and so low is our trust level that they think it will leak from there. This is exactly the arguments that used to happen when there was all the harassment and delays, when exchanges were competing with each other for the large institutional trades. And remember, that algo trading with co-location and servers within the exchange is a completely different ballgame. And it was part of the earlier teething troubles and things that happened, including really ugly competition between exchanges. So let's look, nobody knows how it will happen. SEBI will also have to be pragmatic, maybe introduce things in stages. Key point is approval of algos. How will it be done? Will it be done individually? And if exchanges have to approve of thousands and thousands of algo strategies, how fast will they do it? According to me, they can start with IBT. They don't need and go step by step. Now, those opposed to SEBI's move to treat API-linked trades also suggest that there are alternative checks and balances to prevent market abuse and manipulation. They talk about limiting orders in a big way. So they say maximum order limits per minute or speed bumps, restrict volumes per day. If you ask me, all this is equally onerous at the end of the day for a broker to implement. And the focal point is again the broker, whether it should be through speed bumps, whether those are violated, whether it is through telling every individual that you can only trade up to so-and-so amount, checking their net worths. In any case, people submit income tax documents to the broker. It is a tough choice to make. I'm assuming that SEBI, after having set up a committee, and I know that they spoke to a lot of people in the industry, have weighed these options and come up with having a unique code and tracking APIs is the best way. There is always resistance to any kind of regulation. To my mind, this area needs to be regulated. I've been tracking regulation for 3 decades. In fact, ever since SEBI was an idea, then got its statutory teeth, and I know with kind of anger, every single new regulation is met. Market intermediaries do not like it. There is enormous anger, resistance, lobbying. There are polarized views. And then finally, there is acceptance. This time, in fact, is slightly different. The request for regulation and clarity has come from within the industry, from algo writers. Some brokers don't like it. There may be quibbles about form, process, and implementation, but SEBI can follow up by ensuring that it starts the regulation, looks at how it goes, encourages swift innovation and clearances, and makes the market safer, especially for newly minted retail investors. Because if something goes wrong, because SEBI is watching in silence, then it is the regulator which will have to take responsibility. Those of you who are interested in a more detailed discussion, the Zoom call that we made with 20 odd people from the industry, here's a link. You can search on this same website. You can subscribe to us so that you get access and you can spread the word. Thank you.